Hey everyone, Adam Simmons here from Dgtl Infra, short for digital infrastructure. Wow, Crown Castle and Elliott Management really have a heated debate on their hands. In this video, I'm going to give you a quick overview of what is going on, and I'm going to give you information on the merits of different parts of digital infrastructure being debated by Crown Castle and Elliott, including towers, fiber, and small cells. I will also guide you to part 2 of this series, where I discuss the specific points of Elliott Management's plan for Crown Castle, the actions that Crown Castle has taken to date in response to Elliott's proposals, and how this debate could affect Crown Castle's stock price going forward. I will link to the videos for part 2 of this series down below. You might actually be able to make some money off of Elliott's work without having to invest $1 billion of your own money, so stay tuned, and I will break this all down for you. Before I do, be sure to subscribe to the Dgtl Infra channel and turn on the notifications, so you don't miss my next in-depth video that is coming out soon. Now let's jump into the video. Okay, so quick background on the two parties involved. First, we have Crown Castle, which operates 40,000 towers, 80,000 route miles of fiber, supporting more than 70,000 small cell networks, entirely based in the United States. And then we have Elliott Management, which is an activist hedge fund investor with $41 billion of assets under management and 161 investment professionals throughout New York, London, Hong Kong, and Tokyo. Elliott Management took a $1 billion economic interest in Crown Castle and released a presentation and letter, seen here, at reclaimingthecrown.com, targeting Crown Castle's capital allocation strategy after first approaching the company privately with its plan in May 2020. Specifically, the report recommends that Crown Castle Management reduce its aggressive investments in fiber and small cells going forward, with a new focus on return on invested capital, or ROIC. Furthermore, the report goes on to say that Crown Castle needs to increase its dividends significantly and refresh its board of directors to reduce a large valuation discount that the company trades at relative to its publicly traded peers, American Tower and SBA Communications. So now let's frame out Crown Castle in a bit more detail. Crown Castle's business comprises 3 of the 4 main verticals of digital infrastructure, including towers, fiber, and small cells, which are all helping facilitate the rollout of 5G technology. Consumer wireless devices, including smartphones, laptops, tablets, and wearables, are becoming more bandwidth intensive. Carriers in the United States, think AT&T, Verizon, and T-Mobile, are among the first in the world to offer commercial 5G mobile cellular communication services to support this growth. Crown Castle is providing that digital infrastructure for these carriers to continue to focus on improving network quality and expand capacity through 5G initiatives, by utilizing a combination of towers, fiber, and small cells. To meet the higher capacity and lower latency demands of a 5G network, the investment and density of digital infrastructure assets will need to increase. Crown Castle's revenue is divided into 4 main segments, including towers, which contributes 59% of revenue, fiber, which comprises about 22% of revenue, small cells, which make up 9.5% of revenue, and what is known as site development services, which adds the remaining 9.5% of revenue. Site development services is less of a focus here, but basically that is where Crown Castle performs site acquisition, architectural and engineering work, zoning and permitting work, and tenant equipment installation. But that's not going to be a focus for today's discussion. So if we look at the 3 graphs on the page, the first, on the left, is return on invested capital, which is defined as site rental gross margin divided by invested capital, which includes the goodwill that Crown Castle has paid for prior M&A it has done. We'll show you Crown Castle's explicit calculations for this metric later on in the series. As you can see from this graph, return on invested capital for Crown Castle, dating back all the way to the year 2000, has underperformed American Tower, and since 2004 has underperformed SBA Communications. This is translated into a subpar trading multiple for Crown Castle versus American Tower and SBA Communications, as seen by the middle chart, where Crown Castle trades at a 26 times next 12 months, or NTM, price to adjusted funds from operation, known as AFFO, compared to American Tower at 30 times and SBA Communications at 31 times. As a note, AFFO, or Adjusted Funds from Operations, is a REIT, or Real Estate Investment Trust, earnings metric, which better reflects the ongoing cash costs of operating a REIT's property portfolio. Finally, the chart on the right demonstrates that Crown Castle has underperformed peers American Tower and SBA Communications on a total return basis every year for the past 10 years. Total return meaning a combination of stock price performance and dividends received over that time frame, assuming that the dividends are reinvested in the company's shares. So now let's frame out the different components of digital infrastructure and how they fit into this debate between Crown Castle and Elliott Management. Specifically, we'll talk about towers, small cells, and fiber. So despite common misunderstandings around wireless communication and the cloud, the entirety of global communications networks are reliant on physical infrastructure assets. Digital infrastructure is the physical link that is driving connectivity as internet traffic, mobile data traffic, and data storage needs increase. 5G will require more spectrum, cellular tower sites, fiber, small cells, and even data centers. If we use this page as a visualization of a typical city, we can explain how some of the different pieces of digital infrastructure coexist to deliver bandwidth. Let's take an example we would all know, where a user wants to watch a Netflix video on their iPhone. So in order to start this process, the first step is that the user initiates the download on their iPhone, which associates with either the nearest cell tower or small cell site. Let's assume that the user is over by the houses on the right side of the page. And in this case, the connection is made with a small cell site down by the traffic lights in the bottom right corner of the page. This is because the small cell site is physically closer to the user than the tower sites, which are located at the top and middle of the page. Next, the request that the user made then travels via fiber to a mobile switching center housed in a data center, being on the left side of the page. The mobile switching center communicates with Netflix to determine the closest location of the video. The video is downloaded from the Netflix cloud data center and travels back via fiber to that mobile switching center inside that data center on the left side of the page. Then, the video travels from the data center via fiber back to that small cell site on the right side of the page near the traffic lights. The final step is that the signal travels wirelessly over spectrum from the small cell site to the user's iPhone, and the user is able to watch their Netflix video. The vast majority of this connectivity occurs over wired infrastructure without the user even knowing about it. So now that we understand how all of the pieces of digital infrastructure coexist, let's discuss some of the business model aspects for each of these segments. First, we'll start with towers. Towers serve as the core of the network and the current underpinning for 4G and LTE networks, but are also central to the performance of 5G networks. In terms of revenue model, vertical space is leased on the tower so that multiple tenants can place their communications equipment on that tower, with the capacity to support 4 to 6 different tenants. Towers benefit from the increased carrier activity to support rising data usage, technological upgrades, and new spectrum deployment. In terms of business model, it's characterized by recurring revenue, rental escalators, long-term contracts, think initial term of 5 to 10 years, high operating leverage or incremental margins, low maintenance capital expenditures, and leases to investment-grade counterparties. Beyond the traditional mobile operators, the customers for towers also include TV and radio broadcasters, public safety, and Internet of Things providers, or IoT. Now, if we think about the context of Crown Castle's towers compared to their peers, we can see why Elliott feels that Crown Castle's underperformance is especially disappointing because its US tower portfolio has much more attractive characteristics than its peers, American Tower and SBA Communications, and Elliott feels it's better positioned for the 5G upgrade cycle. On this page, we have 3 proof points of that. So first, on the left side of the page, Crown Castle has 50% of its sites in the top 50 MSAs, which are metropolitan statistical areas, or just another term for contiguous areas around a major city, with 62% of its tower sites in the top 100 MSAs, whereas American Tower has 34% of its sites in the top 50 MSAs and 45% in the top 100 MSAs. SBA Communications has 32% of its sites in the top 50 MSAs and 43% in the top 100 MSAs. Additionally, in the middle of the page, we can see that Crown Castle has the highest percentage of its towers in suburban and urban locations at 50%, which compares to American Tower at 36% and SBA Communications at 32%. Finally, on the rightmost side of the page, we can see that Crown Castle's towers are in areas with the highest population density compared to peers of 2,900 people per square mile. Crown Castle's towers have an average population density that is 30% higher than the national average of the United States, and materially higher than both American Tower and SBA Communications. Higher population density tends to drive factors that lead to higher rents for towers. Continuing on to the overview of the different segments of digital infrastructure, we will skip data centers number 2 for now, given it's not really a focus of the debate between Crown Castle and Elliott Management. Moving to fiber then, number 3, is optical cables that consist of bundled glass strands that transfer data signals into optical light. Fiber is this connective tissue that supplies and enables all of the 3 pieces of digital infrastructure to work. So it's connecting to towers, fiber is connecting to data centers, and fiber is connecting to small cell sites. Fiber provides the core connectivity for internet traffic globally and connects cellular tower sites, data centers, small cells, and last-mile customers into the broader global network. Fiber can typically be categorized into 2 different types: dark fiber and lit services. Dark fiber is the leasing of individual fiber strands to provide dedicated, high-bandwidth, fixed network capacity where the customer lights the fiber themselves. Whereas lit services is where the service provider lights the fiber and enables connectivity for the customer, ranging from megabits per second of capacity to 100 gigabits per second of capacity. The revenue model for fiber varies by segment, but can typically be parsed into 2 different segments or customer bases, known as wholesale fiber or enterprise fiber. Wholesale fiber is carrier-to-carrier traffic, where connectivity services are provided for mobile operators, think AT&T, and other fiber providers like Cogent Communications. Enterprise fiber is the supply of connectivity services to businesses both small, medium, and large, government agencies, healthcare providers, and telecom providers. In fiber, the contracts also vary by the 2 segments. Enterprise fiber contracts typically range from 1 to 3 years in duration, whereas wholesale contracts can be 10 years or as long as 20 to 35 years on a long-term IRU, which is an indefeasible right of use. Finally, moving to number 4, small cells. Small cells are low-powered antennas connected via fiber strands that are typically deployed in dense configurations and closer to wireless customers than tower sites, which brings that true low-latency solution for the consumer. So how do small cells work? Small cells require 3 critical components. First is the radio access network, or RAN, where the actual core radio is located. Second is the fiber, dark fiber that runs under the street or on top of utility poles ultimately connects to an antenna on the small cell. The antenna for a small cell is referred to as a node, and that node broadcasts either one set of frequency bands, or some nodes can transmit multiple frequency bands. Customers on the small cell networks are wireless operators, think T-Mobile, and cable operators like Charter Communications, which uses them for its Spectrum Mobile offering. Contract durations for small cells are very similar to cellular towers and range from 10 to 25 years in duration and usually have a fixed rental escalator, albeit a bit lower. And similar to towers, the vast majority of customers on small cells are investment-grade tenants. Okay, so now with that overview in mind about the different business models and characteristics of the different segments within digital infrastructure, the debate between Crown Castle and Elliott is one of really strategy, capital allocation, and what that means is basically trying to understand where Crown Castle should be investing its money and time. And that money and time translates into a return for shareholders. So to understand all of that, we need to think about how the risk and return spectrum for the different segments of digital infrastructure all fit together to know where each incremental dollar that Crown Castle will be investing between towers, fiber, and small cells places it on the risk-reward side of the spectrum. So starting with towers, on the left and bottom side of the risk and return spectrum, towers are generally considered lower risk and thus lower return assets for new investments that are to be made. Tower companies enjoy stable business models anchored by these fixed revenue escalators, which are typically 3% in the United States and are protected by long-term lease contracts of 10 plus years, with strong tenant counterparties like AT&T, Verizon, and T-Mobile. The tremendous operating leverage and incremental margins from adding new tenants to the same tower makes towers an attractive business. And because of this operating leverage, the tower business is predominantly a fixed cost business. Therefore, adding incremental tenants or new equipment for existing tenants typically does not require much in additional costs and generates incremental gross margins exceeding 95%. By increasing tower occupancy through adding the second, third, and fourth tenant to the tower owner is able to generate a greater return. So if Crown Castle initially has AT&T on its tower, adding T-Mobile or Verizon to the same tower site is incredibly profitable for Crown Castle because it's a new revenue stream and it costs them almost nothing to do so. In summary, the tower business model is less complex and has been easier for investors to understand, positioning it on the low-risk end of the spectrum, which means that new investments will generate lower returns, implying higher valuations for companies like Crown Castle that have existing tower assets. The strong and defensive nature of Crown Castle's United States tower business, with its robust free cash flow, which is defined as EBITDA less capital expenditures, is able to support Crown Castle's approximately 3% dividend yield. Now moving into the middle of the risk-return curve is wholesale or dark fiber. The contract length here is again a long-term lease agreement with other carriers where the owner of the wholesale or dark fiber carries the traffic. The duration of these contracts can be between 10 years and 25 years, with some indefeasible rights of use extending up to 35 and even 50 years. The customers are again carriers, think AT&T, Verizon, and then also other international carriers that need to access traffic in the United States. So carriers like Telefonica from Spain, Vodafone from the UK, and Bharti Infratel from India. Hyperscale is another category of customers for wholesale or dark fiber. These customers include companies like Amazon Web Services, Microsoft Azure, Google Cloud, and Facebook. So let's dive a little bit deeper into the business model of wholesale and dark fiber to understand how the risk and return plays out. So the owner of the fiber builds the route, lays the conduit, which is the tubing that is placed underground to house and protect the individual fiber strands, and then lays down the dark fiber. The market is currently building between 240 to 480 strands of fiber in terms of capacity, which is very dense dark fiber that allows it to be leased over the next 10 years. Initially, Leases on dark fiber routes are for 4 pairs or 8 pairs of fiber with the hyperscale customers like Amazon Web Services or Google Cloud. Following that initial lease up, enterprise customers become the focus, with companies like Delta Airlines leasing 20 pairs of fiber. Because enterprises like Delta Airlines also lease fiber on long-haul networks, within the first 2 to 3 years of those wholesale networks being built, 20 to 30% occupancy is able to be achieved. This occupancy translates anywhere from 12 pairs to 100 pairs of fiber that can be sold within the first 2 to 3 years of building the asset. Further capacity or capability then exists to sell the remaining 200 pairs to 300 pairs of fiber over the next decade through additional lease-up. Oftentimes, on long-haul fiber routes, customers initially sign a lease for 2 pairs or 4 pairs of fiber, but they return in 2 to 3 years' time having used up that bandwidth and want to lease additional capacity in the form of another 2 to 4 pairs of dark fiber. Because of this incredible demand for bandwidth, fiber routes are being built for the long-term nature of growing network capacity. So then if we think about the anchor economics for building wholesale and dark fiber, in today's market, investors are underwriting to as low as a negative 2% IRR on a cash-on-cash basis to as high as 4% to 5% IRR on an unlevered basis. Then, as additional lease-up occurs in the medium term, the economics of wholesale routes that are initially built with 2 tenants are able to, within the first 24 to 36 months, add a 3rd, 4th, 5th, and even 6th tenant, allowing the owner of the fiber to achieve an 8 to 10% unlevered IRR. After including leverage, infrastructure-like returns of 14% to 18% IRR on a levered basis are able to be achieved, which is attractive, and that's why you've seen a number of infrastructure funds and private equity funds migrate to the wholesale or dark fiber business. Next, let's move into the high part of the risk and return curve and talk about small cells. In small cells, the contract length is typically 10 to 25-year leases, which is similar to wholesale dark fiber and towers. Small cell leases include multiple 5-year renewals and built-in escalators on that lease contract of about 1.5%. Significant capital expenditures are required to build small cells, primarily related to the fiber that is needed for them, because the small cell node costs approximately $10,000 to $12,000. In return for the fiber and small cell build-out, a high concentration, think 3/4 of tenants, are investment-grade counterparties. Incremental revenue on small cells is generated through tenant additions to an existing network similar to towers, meaning adding another carrier to that small cell, or equipment services as carriers upgrade new equipment to support spectrum bands and higher capacity. Because of the nascent nature of small cells, the return on invested capital, or ROIC, on small cells is rising faster than any other form of digital infrastructure, as the cost per node has fallen substantially. Small cell densification is occurring from 1 or 2 nodes per route mile, up to 5 to 10 or more, which is causing the cost per node to fall, while pricing, in terms of lease rates, has generally remained flat, and Crown Castle references this later on in this series. Fiber is the most expensive piece of the network build. The small cell itself is strand-mounted and relatively inexpensive, costing about $10,000 to $12,000 per node. Therefore, returns on small cells are increasing and are expected to continue to grow materially in the future. The coming adoption of 5G will create an inflection point in the wireless industry that will require improvements in traditional infrastructure, and small cells are the only technology that can allow for widespread 5G adoption. Finally, enterprise fiber, which is furthest out on the risk and return spectrum. The contract length for enterprise fiber is materially less, with weighted average contract durations between 1 to 3 years. Enterprise fiber connectivity is typically provided to customers that are business enterprises and are sold either lit or dark. The owner of the fiber cuts the fiber and builds a fiber lateral into an enterprise, whether that is a multi-tenant office building, an industrial park, or corporate headquarters. In terms of competition, enterprise fiber customers, given the competitive environment, typically have 4 to 5 competitive options to choose from in any given market. So it's a very competitive business, has high churn, but also has high growth at the same time. The net growth after churn of enterprise fiber is about 3%. By providing that overview of each of the 3 verticals of digital infrastructure, including towers, fiber, and small cells, which Crown Castle is focusing on, it highlights why an activist hedge fund investor like Elliott Management may have a difference of opinion as to where Crown Castle should be spending their time and money strategically. So now it's worth just recapping in summary how the different segments compare to one another. In terms of business model, fiber has a higher capital intensity and higher customer churn rate, and at the same time, a higher risk and potential reward than towers. Crown Castle operates in both the wholesale dark fiber segment and the enterprise fiber segment, but is spending most of its time focused on wholesale and dark fiber because it's used to build out its small cell business as well. Enterprise fiber was primarily an acquired asset through different acquisitions that Crown Castle did historically and is not a focus for investment at this time. So the small cell business is very core to Crown Castle's underwriting of fiber investments and is still minor in terms of revenue contribution. Recall that it's about 9.5% of total revenue. Crown Castle believes that fiber and small cells have upside optionality over the long term, especially as this asset will become more integral in a 5G world as demand for 5G increases. So Crown Castle's view is it's a higher return grouping of assets, but at the same time, because it's unproven, it's a higher risk asset to invest in as well. In terms of reinforcing that risk, fiber and small cells have lower rental escalators built into their contracts. Small cells have a 1.5% escalator, and fiber actually has none. Whereas on the tower side, 3% rental escalators are typically built into the contracts, providing that security. In terms of churn, fiber, particularly on the enterprise side, experience heightened levels of 6 to 9% per year compared to churn of only 2 to 3% for towers every year. Focusing on tenancy, the small cell asset currently has about 1 to 2 tenants per node, whereas towers in the United States have on average above 2 tenants per tower site, with the capacity to grow to 4 to 6 tenants. So in summary, Crown Castle's small cell investment thesis remains unproven given how relatively subscale the business is, and limited visibility on path to longer-term returns. If we think of positioning, Crown Castle is taking a higher risk and potentially higher return strategy, whereas Elliott wants them to focus on the tower asset where they have generated substantial returns in the past and wants them to focus their attention to keep doing that in the future. So that wraps up part 1 of this video series. Hopefully you found this video helpful. If you did, then please share it with somebody you think might also find it helpful. In part 2 of this series, I will discuss the specific points of Elliott Management's plan for Crown Castle, the actions that Crown Castle has taken to date in response to Elliott's proposals, and how this debate could affect Crown Castle's stock price going forward. Consider subscribing to Dgtl Infra and visit us at dgtlinfra.com for more of the latest news on digital infrastructure. Thank you for watching this video. Be sure to like the video and post in the comments telling me about whether you think Crown Castle should make changes to its strategy given the underperformance relative to American Tower and SBA Communications. Thanks again for watching, and I will see you in the next video.